Confusion is sweeping the crypto world. The IRS has doubled down on tax compliance with sweeping new rules, leaving investors and brokers scrambling to keep up. From the just implemented wallet account tracking mandates to now delaying of broker reporting requirements, the timeline is kind of a tangled mess. And new presidential administration only adds to the uncertainty. So, what's changing? What is staying? And how can you protect yourself from falling into the compliance trap? Stay tuned as we cut through the noise and uncover the strategies you need to stay ahead in this rapidly evolving crypto landscape. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, if you like this video, please like, subscribe, leave a comment below so you continue to get top-tier content from industry experts who have been around the block. I'm Noah Buxton, and I'm here with Nick Ward from the Network Firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. Nick, good morning.
Good morning. How are you?
I'm doing well. I think I've seen, online out of last week, a lot of confusion, people trying to figure out, wait, what changed? I just had to do this whole compliance exercise and scramble at the end of the year, and now I don't. Or I think some people are a bit confused. So
Yeah, I was one of them. Call it a victim to the headline era we're in, where someone gets a hold of a headline and you just see it everywhere posted the same way. So yeah, last week, I think it was Friday, I got the notification IRS delays crypto regulations. And I not only saw it myself, I had several people forward it to me. And so it was a good weekend of catching up on what's the IRS doing, which is always fun.
exactly. Yeah, I mean, we'd been working for a lot of our clients had already kind of been set up for this. We knew the wallet by wallet and by account tracking was coming, the Rev Proc 2024-28. We knew that was coming. So a lot of our clients were set up, but we had a handful of new clients and some of the more complex ones that we really need to get over the line for either safe harbor or just compliance by the beginning of the year. And so, yeah, for like a solid month, we've just been going crazy, working with clients, working all through the holiday, working over the new year. And then, I saw this headline. I was like, wait, what? All for naught? No, not all for naught. So to be clear, recent changes in the U.S. cryptocurrency tax landscape, including that revenue procedure 2024-28 and the delayed implementation of this broker reporting that we're referring to, they've created both clarity and, again, confusion for both the taxpayers, brokers, quote unquote, as IRS calls them. We typically refer those, as exchanges or centralized exchanges. And of course, anybody participating in the industry. Let's go in. We're going to try to do a detailed analysis, give you the background, sort of what's going on here. So first, let's cover that background. We want you to have the full context and understanding so that you can navigate knowledgeably. Then we want to clarify this recent IRS delayed rule that they've announced just last week. And finally, let's get into or conclude with some kind of key takeaways that you need to move forward without stepping on IRS landmines. Yeah, I think the first thing is we're talking about two things here, right? This revenue procedure and this broker rule. So maybe, if you want to, Nick, give us a quick take on these two things and maybe how they interrelate.
Yep. So I think the revenue procedure, as you mentioned, we've been working with clients over the last month because one of the key changes was you had to record your crypto dispositions by wallet going forward. And so obviously, I think most people in the space had used a universal application, meaning just if I have some Bitcoin, regardless of where it is and where I'm liquidating it from or spending it from, I'm going to apply my cost basis on, say, a first in, first out basis. So whatever Bitcoin I bought first, I applied that cost basis, regardless of if it came from that exact wallet or not. And so with the change, they had required they allowed a safe harbor to take place to kind of organize your wallets by cost basis before January 1st of this year, 2025. And so that's what we've been doing the past month with a lot of clients, is just explaining, walking them through that, helping them get ready so they could organize their wallets going forward and kind of know what cost basis is in which wallets. I think that's one of the key points there with that revenue procedure 2024-28.
Exactly. Yeah. And this kind of standing on its own, is a total pain. If you want to give IRS the benefit of the doubt here on this one and try and be fair about it, you could say, hey, they're trying to actually make this a little bit easier. I'm not sure that it's actually easier, but that's kind of one way you could think of it. They're trying to simplify and clarify the reporting rules for individuals and companies, which I think is net a good thing. We do need more clarity across the space. So I think that's good. And then, okay, so that's the revenue procedure, now let's go into, and that stays. I'll just say right now, the changes that were announced last week, the delay of a rule implementation, to be clear, that does not affect the individual taxpayer. That rule stands. You still have to organize your tax basis inventory, your lots by wallet and account. And going forward in 2025, when tracking dispositions or sales for the purposes of recognizing a capital gain or loss, you have to do that on a by wallet or by account basis. Now we could explain, if you think there's more to explain there, but we did an episode just a couple weeks ago. Actually, it's a full month ago, I think. So look back on the Network Firm YouTube page if you want to check into a little bit more detail. We went way deep on that one. Okay, but now there's this delayed broker reporting requirement. So maybe just at the high level, Nick, what do brokers, let's talk about the old rule before it was changed. What did they need to do? Basically, what was upcoming here for them?
Yeah, so with the new change, the brokers were now going to be expected to report this new form, right? The DA, which I'm sure a lot of our listeners have heard rumblings of. And so that form was going to require the brokers to report their customers' activity in the sense of what was the actual cost basis, how much in proceeds for liquidations did they get. And as always with crypto, right, the question becomes, well, how does the exchange know what the cost basis is? Because you could be taking Bitcoin, that you mined, or just that you had bought on another exchange from a personal wallet and moved it in there. And so that is the change that was now going to happen, is they were going to have to ask their customers essentially, what is your cost basis when moving digital assets onto the platform, so that they had all the data to report it on this new form.
Right, exactly. Yeah, so they were going to have, it was two phases in 2025. So for the tax year 2025, meaning sort of early 2026, these brokers or exchanges would have had to report only gross proceeds. So again, let's use a one Bitcoin deposit example, right? Deposit a Bitcoin to a centralized exchange, a Kraken, a Coinbase, Gemini, the other US exchanges or wallet providers. And let's say you sell that Bitcoin at 100K and take cash off the platform. That would be 100K in proceeds. The exchange has no idea what you bought that Bitcoin for, but under this Infrastructure Investments and Jobs Act requirement in 2025 tax year, they would only have had to report your proceeds on a 1099 digital assets or 1099 DA. So the IRS would get a 1099 DA and they would say, okay, Nick sold one Bitcoin for 100K on Coinbase. You would get a copy from Coinbase, let's say. You sold 100K of Bitcoin in 2025. That's all they had to do is just proceeds. And then in 2026, so reporting in early 27, they would have had to do both proceeds and the cost basis reporting. So I think most of our listeners are probably pretty savvy, but if this is still a little bit confusing, let's just take it to a TradFi analogy real quick and why this is a problem. I think this helps people understand. So imagine you have a Schwab, an E-Trade type account, a Robinhood account even, right? And you're trading securities. In those cases, the broker dealers can really only take cash in and they can only put cash out. If you want to move from Robinhood to E-Trade and over to Schwab, let's say all in 1 year, you don't take your Tesla stock or your Apple stock or whatever you have and just transfer it, right? You have to liquidate that holding, take it to cash, and then move it to the new brokerage and rebuy your position. And so that's very different than crypto, right? Crypto is digital property. It's a digital commodity, and it is transferable on chain between these broker dealers. You can use a withdraw on one exchange right into a deposit address on another exchange. And so there is information sharing between these exchanges for the purposes of AML KYC reporting. So you should know that when you're doing that kind of activity, these exchanges are sharing your information, for compliance around that transaction itself. But there's still no basis. They don't know what you paid for that Bitcoin. Even if you bought it on Coinbase you bought that Bitcoin on Coinbase, let's say over a year ago for 25K or 30K of cash. If you take that Bitcoin and transfer it to Kraken or Gemini, those exchanges still don't know the basis. And so that was the idea here, is that in 2026 tax year, the exchanges would have to know your cost basis, and they would be able to report that again. One form goes to the IRS, a consolidated form goes to the individual, and then theoretically that makes the tax reporting easier, right? So these rules actually work together. The idea is that the individual does it by wallet and account, has sort of each wallet or each exchange account become its own sort of individual ledger. And then meanwhile, the broker or Coinbase, right, is reporting hopefully the same thing, right? Those things should reconcile, right? So for the simple traders, I think this does make it easy, right? Like if you just have a Coinbase account, then your tax reporting will become very easy, more like having a Schwab account, right?
Mm-hmm. Yeah, and that makes sense, and that come circling back to this, AI headline that got pumped out over and over again. That's really the key of what the delay applies to, right? Is to those brokers and that requirement.
Exactly. So you could think of it this same exact thing that I just explained: gross proceeds in 2025 from the exchanges, and then in 26, gross proceeds and capital gain or loss from those dispositions. Just shift the window 1 year, basically. So it becomes 2025. The exchanges actually don't have a reporting requirement still, and 26 and 27 they do.
Okay, understood. Yeah, and it doesn't apply again to anything the individual. You still need to track those individual the wallet by wallet to apply your cost basis. That'll be the same regardless. You just likely won't be giving the exchange your cost basis this year, as they have time now to build out infrastructure or figure out how they're actually going to track that.
Exactly. Yeah, that's a really interesting side point of how they're going to do this.
Yeah.
We have a few ideas about that. There'll be I think a manual. You could expect in 2027 for sure, a manual sort of exercise where, maybe your deposit is cleared for trading. It's made, its on-chain confirmations are sufficient. You see it in your account, but you probably have to then do one more step before you can actually trade with those assets.
Yeah, that was my expectation. As I move my Bitcoin into the account, and I'm going to be greeted with, hey, what's the cost basis before we move ahead? And you'll have to input that.
Yep. Yeah. Yeah, it's there'll probably be some other strategies which relate to information sharing between exchanges and or crypto tax software providers, which I'm a little less excited about, I would say, just because I think that's, more private financial data essentially that's shared, where I think it's not necessary really. So anyway, we'll see what happens, but okay, so I think we've got through what the individual must do and the exchanges and brokers must do. So, maybe what is the implication here for individuals? I hope we've clarified, but, I think in one way there's an increased burden. Do you see it that way? Like there's, again, the broker report have been delayed, and there's this by wallet and by account tracking still. Is that an increased burden for now?
I think so. Again, a lot of our clients, right, they act first, so they make their trades throughout the year. They go through all that, and then it's come tax time when they first start thinking about, all right, what was my cost basis? What do I have to apply? Where now I think it's going to be much more in the moment of, all right, I need to move to an exchange. Do I even know the cost basis, right? If I had some obscure wallet from years ago that I've been stacking in through several different ways, I need to think about that when I move on, because you don't want to giving the exchange the incorrect data at the time and thinking you'll figure out later is going to probably create an issue down the road, because the IRS is going to get the information you originally input. Maybe the exchanges will have an option to say, I need to adjust what I put in, but that's yet to be seen. And again, going back and forth on that front is probably not something taxpayers are going to want to be doing.
Yeah. Yeah, I think I agree. It's kind of an increased burden, like, a couple client examples, things, individuals watching might be facing. Basically all of the tax software that's available commercially for many years used what's called a universal approach. And so that meant, think of, you could have as many, excuse me, wallets or exchange accounts as you can imagine. But if they're all synced to the software, and then you've chosen your inventory accounting method, FIFO, HIFO, LIFO, right? Beginning, they only supported FIFO, but they still tracked everything universally. So it's like everything in the software was one big ledger, essentially. It was sort of one main wallet. And so if it was the first you sold Bitcoin, let's say, and let's say you had 3 wallets, right? Old Bitcoin, sort of medium Bitcoin, and brand new Bitcoin that you're DCAing, let's say. It would, if it was FIFO, it would always be selling old Bitcoin, right? It'd be selling first in, first out, irrespective of the actual wallet that Bitcoin was in. And I think for people that are, have been in the space for a number of years and have a number of wallets and have these very different periods of acquisition, the sort of top of the market DCA, it's fine. I'm still buying Bitcoin at 100K because I just do that with a weekly, with my paycheck or whatever, versus, early buy Bitcoin or OG Bitcoin. That's really different, in terms of the tax implications, right? On the one hand, you're going to get the older Bitcoin, you're going to get the benefit of that long-term treatment, lower tax rate. On the flip side, you might have a significant difference between cost and disposition value, meaning a big capital gain number. And so the softwares have, changed. They've implemented features to try and address this. Some of the main ones have, not all of them, I don't think. But even with the software, it's like, it almost requires the individual who has some complex holdings to be like, okay, I'm doing HIFO or FIFO, but really in my mind, you need to be thinking in a specific ID sense. Like, what are you actually intending to sell? So
yeah, and I mean, right, as our listeners know, you can spin up as many wallets as you want. Frankly, I know plenty of clients and friends in the space that have multiple wallets from a privacy angle, because we know Bitcoin isn't the greatest when it comes to privacy. So your best bet is just multiple wallets to, organize yourself that way. And so you do, to your point, you now have a lot of different avenues to track and report back when the time comes. Maybe for a second, it's January 5th. So our listeners who are tuning in for the first and thinking about this for the first time, maybe hearing this for the first time, have they passed the date? Is there still an opportunity to organize those wallets and capture that safe harbor if they haven't transacted yet?
It's too late. You're going to jail. No, just kidding. Yeah, no, it's the rule is technically required. If you wanted to achieve this safe harbor treatment, which was essentially, hey, my stuff is too messy and too old and I'm not quite sure on some things, you have this period to allocate unused basis, as they say, which basically means, okay, I'm going to give these things a fair value. I'm going to, tie them to a wallet, move them to a wallet, record them, maybe they're across multiple wallets, but sort of record this as one sort of big bulk wallet of old stuff. I don't know exactly. But as long as you do good record keeping on that, you get the safe harbor by January 1st. Then it said, well, for anybody else, like let's say you've tracked your stuff very well and it's relatively simple. You have a tax software, let's say. That was, you had to do by wallet by your first disposition in 2025. So the markets are relatively active right now. You might have done a trade or two, and I don't think it's the end of the world. The reality here is that IRS thinks everybody does this, and tracks everything for exactly every trade. I think the reality is that there's always some backward looking aspect to this. There's always some cleanup, using the software, reconciling transactions. So no, it's not too late. I definitely would urge you to take this seriously though, and, do some good hygiene, organize your stuff. If you need help, reach out for help. This is exactly what we do, right? Is help individuals navigate this maze, basically.
Yeah, absolutely. Okay. I think we've covered the main topics. Maybe anything else before we kind of recap?
No, I think that's it. Yeah, let's run the recap. So basically, taxpayers definitely begin tracking transactions by wallet and account. That's starting January 1st or your first transaction. And that's regardless of these broker reporting delays. These two rules are associated, but this didn't change your individual or corporate compliance requirements for now. Safe harbor provisions, those, the date has passed. January 1st or 12/31 was the sort of safe harbor date. If you wanted to clean up and allocate this old stuff, could you still try and do that exercise? I think if you are, experiencing that level of trouble where you have old basis, old wallets, disorganized stuff, I think you should still do it. It'll be, whether you're over the line on safe harbor or not will be the question if it were to come to an audit scenario. But again, still a good exercise to do. Brokers will not be required to report until 2026. In that year, they'll report only your gross proceeds on the centralized platforms that you trade on. And in 2027, they will report both the proceeds and the cost basis. And that brings it into alignment with that typical securities brokerage example that I gave, right? Where they can give a very holistic tax report. Yeah. So of course we're biased, but engaging crypto tax professionals using a good software is pretty crucial to navigating this complex space. And again, staying off of the IRS landmines.
Yeah, no, it's a good recap. And as always, reach out with questions. We've had plenty, as you mentioned at the top of this. Over the break, we had a lot of people reaching out. What do we do? So we're here to help. Don't hesitate. Don't wait. Get it done now so that you can be smooth sailing and sleep well going into the tax filing date.
Exactly. All right, we'll put a bow on it. Thanks for joining us for another TNF Takes. We hope you found it helpful. Again, don't forget to like, subscribe to get more top tier content from industry experts who have been around the block. You can find us at thenetworkfirm.com. You can schedule a call directly with us there. And we look forward to hearing from you.
Thanks, Noah.
Thanks, Nick.